Today, we are tearing into Cenovus Energy's fourth quarter 2025 earnings. And let me tell you, it was a really interesting quarter, defined by some powerful operational performance and a truly game-changing acquisition. So let's unpack what it all means for the stock.
All right, let's not waste any time. We're going to get straight to the numbers that are really driving the conversation here.
So the big story right out of the gate was a massive earnings beat. Cenovus delivered diluted earnings per share that were a full 28% higher than what the street was expecting. That's a huge surprise.
Now take a look at this slide, because it highlights a really key contrast. You'll see that revenue was actually a tiny bit below expectations, barely a miss. But the real story here is the incredible profitability and cash flow. We're talking diluted EPS of 50 cents versus a 39-cent consensus and a huge $1.3 billion in free funds flow. It's so clear that Cenovus is just excelling at efficient execution, not just chasing top-line growth.
So what was driving this? Well, operationally, Cenovus was just firing on all cylinders. They hit record upstream production, mostly from their oil sands assets. And they returned a massive $1.1 billion to shareholders, with over $700 million of that in the form of buybacks. Now, on the flip side, you can see net debt did tick up to just under $8.3 billion, and that's a direct result of closing that recent MEG Energy acquisition.
Okay, so that covers the what. Now let's dig into the how and see how management is framing the path forward from here.
On the earnings call, the narrative from the C-suite was crystal clear. It's really built around these three pillars. First, just operational excellence, which we totally saw in those record production numbers and their cost cutting. Second, the successful integration of MEG Energy and really unlocking its value. And third, a disciplined approach to their capital. Carefully balancing paying down the debt from that big deal with continuing those strong shareholder returns. That MEG deal is really at the heart of the whole investment case right now, and the CEO's message could not have been clearer. This quote right here shows their incredible confidence in hitting those synergy targets, which is absolutely essential to make this whole acquisition a win for shareholders. So this slide breaks down exactly how they plan to get there. It's a phased approach. They've already snagged about $120 million in corporate synergies. That's kind of the low-hanging fruit, getting rid of duplicate overhead. The next couple of years are focused on operational improvements to hit a $150 million annual run rate. But the ultimate goal, the real prize here, is generating over $400 million in annual synergies by 2028. That is a serious, serious boost to the bottom line. Now, another key project that everyone's watching is West White Rose. This is slated to be their next big driver of production growth. It's in the final stages, but management was pretty upfront that a harsh winter has put that Q2 2026 timeline under some pressure. They actually use the word tight, so this is definitely a variable to keep a close eye on. Okay, so with all of that on the table, how did the market react, and what's the bigger picture looking like?
Well, the market's verdict on the day was pretty positive. The stock closed up nearly 3%. That's a clear signal that investors really liked the strong beat on profitability and that confident execution story from management.
And this chart shows that little stock job is just part of a much, much bigger trend. Look at this. Over the past year, Cenovus has returned an incredible 42%. That's more than double the energy sector and way, way ahead of the S&P 500. This is a clear pattern of sustained outperformance.
But of course, no stock exists in a bubble, right? So let's look at the bigger picture. The main headwind here is the widening WCS differential. That's basically the discount that Canadian heavy crude gets compared to the US benchmark. When that discount gets bigger, it directly squeezes Cenovus's profit margins. And there's some chatter about a potential crude market surplus next year. But on the other hand, WTI prices are hanging out near 6-month highs, and geopolitical tensions continue to support energy prices overall.
So, let's put all the pieces together and see if we can form a forward-looking thesis on this thing.
Here's how we see it. The bull case is actually pretty straightforward. If Cenovus keeps delivering on those MEG synergies and brings West White Rose online smoothly, that free cash flow should just accelerate, funding more strong capital returns. The risks? Well, they're basically the mirror image. Project delays, a sharp downturn in crude prices, or that critical WCS differential widening out could all present major challenges. So, based on the strong operational momentum, that clear path to realizing synergies, and the market's positive reaction, what's our call? We are initiating coverage with an outperform rating. Our view is that even after this strong run, the market is still underappreciating the long-term earnings and free cash flow power that's being unlocked by the mega acquisition, especially when it's layered on top of such a highly efficient operational base.
And finally, as always, we have to share this crucial reminder. This is not financial advice.